don't we kick this thing off? So thank you for joining. We have a new set of webinars where we're going to talk a little bit about the market and talk some of the later webinars this month around some different opportunities. But first, we're just going to do a general high-level market update. It's about some different things that investors are considering. But first, anything you hear today is general advice. So I obviously don't know anything about you. I can't offer personal advice, but it'd be great to hear your thoughts on what's going on and your opinions, and of course, any questions. So if you share those in the chat or in the Q&A, I will get to those as we go along. All right. So very briefly, let's look at two major markets. So we'll look at Australia, we'll look at the US, about what has been happening this year so far as we approach the midway point from a calendar year perspective and the end of financial year in Australia. You can see here the ASX 200. This was as of last night. So up a little less than 4%. Not that bad in the aggregate. And then over here, what we're looking at is we're looking at valuation. So what we're looking at specifically is our analyst view of the fair value of the companies that they are covering in aggregate and how that compares to the price that they're trading at. So just so people understand how to read this chart, which I just got off of our website, you can see a price to fair value of 1 would mean that the market is fairly valued. We think it's worth $1, it's trading for $1. Anything below 1, we would say is undervalued. So you can see the last reading we have here for the Australian market is 0.94. So what this would imply is our analysts believe it's 6% undervalued. So one thing I would say about this that is important to think about and to take these things into account is, of course, as investors, we are focused on valuation, but we also want to be very mindful of a margin of safety. So the margin of safety, which was something that Ben Graham came out with a long time ago in some of his seminal books about investing. A margin of safety just means that there's a lot of uncertainty, and we're going to spend a fair amount of time talking about uncertainty, but there's a lot of uncertainty out there. So as investors, we want to build in a buffer to account for that uncertainty. So we build it in at Morningstar when we look at star ratings. The higher the risk that we see, the business risk of every company, of each individual company, the larger that margin of safety would be. So if we think a company is very risky from a business standpoint, that would be a very large margin of safety. If we don't think it is that risky, it would be a smaller margin of safety. So just remember that that does not take this into account. So that's 6% undervalued. All right, let's flip over to the US. So the US from a performance standpoint, and once again, this is through last night, we can see up close to 12%. And in fact, for anyone who's been paying attention, the S&P 500, which is the 500 largest shares of the US, is right on the cusp of another bull market, even if it doesn't feel that way. So basically, we define a bull market as 20% up from the lows that we saw last year. We'll talk about why we can maybe take this with a grain of salt. But anyway, up close to 12% for the year, right on the cusp of that 20% mark. We go and we look at the price to fair value of the shares that we cover in the US, you can see it's at 0.91. So about 9% undervalued according to our analysts. And that's great, and those are charts. But the other thing we want to focus on, of course, is what happens in the future. Now, our investment management group here at Morningstar does put out, and I've talked about these a couple times during the webinars, they do put out expected returns, and you can read all of the disclaimers about it right here. Expected returns over the next 20-year period of different asset classes. So what you can see right there is what our analysts expect to happen over the next 20 years. I would say that I think based on investor expectations that I hear a lot, this is probably lower than what you think markets have or should return, because it's lower than what they have traditionally returned. Now, a couple things about this. one of the big factors that goes into these expected returns is, of course, valuation level. So valuation level simply refers to how much investors are currently paying for earnings. Higher the valuation level, the lower the expected returns we think will occur in the future, and vice versa. The lower that valuation level, the higher those expected returns would be. So a lot of this does have to do with expected return, or it has to do with valuation levels. So just something to keep in mind that we always do want to look forward. All right. Let's talk about some of the uncertainty out here. And this is where we can dive in a little bit on some of these specific points. And obviously, this is just my point of view, but just seems to be the consensus of things that are out there that are creating this uncertainty in investor mind. So number one, you saw the U.S., saw the S&P 500 up around 12% this year, but it's a very, very narrow market. And in fact, there are 7 big tech companies listed here that have driven all of those returns. So of course, anytime we have a market weighted index, so a market cap weighted index, basically means that the bigger the companies, the more they make up of that index. So their return will have a disproportionate amount of influence on that overall index. And in this case, a lot of these very large tech companies, a lot of them that did quite poorly last year, have done very, very well. And I think NVIDIA, which of course is a chip maker that sort of specializes in chips that go into AI, which we're all hearing a lot about, has had an incredible year. And basically what's happened is most of the market has not done well. And these 7 companies have dragged it up. And so this makes a lot of market commentators very nervous that there is such a narrowly defined leadership group in the market. What we typically want to look for during really strong bull market runs is we want a broad uplift of all of the shares that are in the market. It's obviously never going to be all of them, but more than 7. So a lot of this is making a lot of people very nervous. And of course, one of the consequences of this is if anything happens to one or multiple of those companies that causes them to fall, we're going to see a big impact on the market. So Apple close to a 52-week high, or close to an all-time high. We've seen a huge bounce back by Meta. Of course, talked about NVIDIA. Tesla had a pretty bad year last year, but it's had a huge bounce back. So question, of course, with such thin leadership in the market, the U.S. market, what is that impact going to be? I think if we look to Australia, typically the larger companies are banks and miners, of course. So we have a very similar market where there's been a lot of concentration. In fact, a lot more concentration in Australia. So if anything were to happen to the banks or the miners, we'd see a very large impact on the Aussie market. And of course, a lot of people are quite negative. So despite a really good return, right, a 12% return through not even 6 months of the calendar year, a lot of people are really, really negative. And the Wall Street Journal had an interesting article out the other day saying that short sellers, so generally these are hedge funds and more speculative investors. So of course, when they are going out there and shorting the market, they're actually selling shares or borrowing shares and selling them, have the biggest bearish position since 2007. Now, one very important thing to say about short sellers. So short selling is very, very risky because when we go out there and we buy a share, our losses are defined, of course, at 100%, right? You can't do anything but lose all the money you went in, that you put into a share or the market if it went to 0. But the returns we get are infinite, right? So they can just keep going up and up and up and up. And yeah, I mean, that's a really great deal for us as shareholders. If you're a short seller, the exact opposite is true. The most you can ever gain would be 100% because you, of course, profit when a share price goes down. It can't go down any more than to 0. And you lose money as that share price goes up, and that share price can go up forever. So you can lose a lot of money. So the one thing I'll say about short short sellers. Well, this is certainly an indication that a lot of people think that the S&P 500 will go down. You could also get from those shorts getting covered. So basically those individuals, hedge funds, whoever, that have gone out there and bet that the market's going to go down, if they cover those shorts, they have to go out back there and buy the shares so they can return it to whoever has lent them to them. And that, of course, can drive the market higher. So that's the only thing I'd say. So this certainly shows what people think will happen, but if the opposite happens, you could get a further boost to the market. Debt. So I've been talking a lot about debt lately in different talks that I've done. But we took on as a society a massive amount of debt twice. So during the GFC, and then of course during COVID. And this debt was taken on by governments, it was taken on by corporations, it was taken on to a lesser extent by individuals, but there is a lot of debt. So $453 trillion Aussie dollars at the end of 2022. And since it's really hard to wrap your head around how big that number is, that's $56,000 for every man, woman, and child on Earth, which is a lot. It's a lot, certainly when we compare it to GDP, which we often do to look at the levels of debt versus the economy. So not a great thing, especially because interest rates are increasing. So S&P, Standard & Poor's, S&P, estimated that 35% of debt is floating rate. Obviously, you're going to get the first impact of any of those interest rate increases on those floating rate debt issuers. And they think just during 2022, and remember, interest rates have continued to go up since then, led to $3 trillion in additional servicing costs. So basically, they're paying more for this debt that they've taken out. And that's not great for any of us, right? Certainly not great for an investor, because a company that's paying more for debt is going to have less for us, which we don't like. It is not great for, obviously, a country, because the more debt that a government has and the higher those interest rates are, the higher the servicing costs. That, of course, is money that can't go to other things, other places that governments spend money on, or it means taxes need to be raised in order to pay that off. And then if we just look at the S&P 500, 36% of all the companies in the S&P 500 have a credit rating of junk, which is not great. And as you can see, before the GFC in 2007, it's double that figure. So there's a lot of concerns, I think, out there around debt. And we're starting to see those seep through the system. And we're starting to see the impacts of all these interest rate raises that we had. And just remember that while there's no exact consensus, and obviously the economy is not precise, many economists think that it takes about 12 to 18 months for interest rate increases to work their way through the economy. So what that really means is we're just starting to see those impacts right now. And we've had a couple bank blowups in the US, so that is certainly an impact of those higher interest rates. Locally, where we're seeing some of those impacts is, of course, I would argue what happened to the housing market last year, where we saw a bit of a pullback. We are seeing, which the AFR is endlessly covering, a drop in new construction for housing. We're starting to see a lot of construction companies struggle and some going bankrupt. So we are starting to see the impact of those interest rates. So just remember, there's lots of different ways higher interest rates can impact the economy, but we're not in a great place as a global, as a world, just because of all this debt that we've taken on. And then, of course, there's the ultimate uncertainty. So inflation, still around, seems to be fairly stubborn, or at least there seem to be signs that it's embedding itself in the economy. One of those signs that's caused a lot of talk in Australia is, of course, the minimum wage increase that we saw, where you're starting to see the, I guess, solidarity between governments and central banks and the need to fight inflation coming apart a little bit. let's spend a minute on this because that really has to do with inflation and interest rates. And I'll cover kind of expectations for interest rates in a second. But what we have to remember is the way to fight inflation is, of course, to do things in the short term that a lot of stakeholders in a national economy find really, really difficult to deal with. So generally what it means is raising interest rates, slowing down economic growth, some cases turning economic growth negative, which has all sorts of bad repercussions for people. So number one, obviously, people lose their jobs in any sort of recession. That's not something a lot of people like to deal with, and understandably so. Governments don't really like this because, of course, that leads to them not becoming very popular and they could get voted out of office. So what you've had in the past, and we saw this a lot in the 70s in the US, is we've gotten to a point where central banks have a very different view on what needs to be done than governments. Governments, of course, are all about supporting economic growth, spending more money, trying to increase wages in any way that they can. Central banks are about fighting inflation because they know over the long term, inflation can have a lot of really, really negative impacts on society. So the question is, of course, as we're starting to see these fault lines develop, will this continue? And does that actually really impact that fight against inflation? And the 70s example that I'm really looking back on is during Nixon's presidency, he was obviously very worried about re-elections. So worried he broke into the Watergate building, or broken into. But one of the things that was really impacting things was the fight against inflation and the slowing U.S. economy. And Nixon really took a lot of steps to try to counteract that, to protect his own election prospects. And so that delayed the ultimate victory over inflation to early into Reagan's term. So I'm not saying this is happening again, but what I am saying is that the longer we have inflation, the more you start to see those conflicts. And, we've heard some of it, and a lot of it's been a little bit lampooned, but, some of the statements that have come out of the RBA about how important it is to keep wage growth low so that inflation doesn't actually embed itself, the benefit of people higher rents and higher mortgage payments so people actually economize on where they're living. All of these comments are not things that individuals want. Of course, all of us personally, when we're faced with having to spend more money, would like to make more money to make up for it. But that's really how inflation continues to embed itself in the economy. So a lot of uncertainty around where we're going with inflation and interest rates. And then, of course, the economic environment. So if we go, and I've got a slide next that looks at Australia, if we go and we look at what the market expectations are of interest rate policies in both Australia and the US, the expectation is that there will still be cuts in this calendar year. Now, obviously, we'll get an RBA announcement today, and we'll get an announcement from the Fed next week. Many people are actually expecting the RBA to increase interest rates today. Many people are expecting the Fed to pause, but there's still this expectation that rates will be cut by the end of this year. And so that's obviously going to be a big driver, whether those expectations are met or not, a big driver of what happens in the market. And then, of course, there's recession. So I think, the consensus is the U.S. will go into recession. I think people are more optimistic in Australia. But once again, a lot of uncertainty overhanging the market. All right, so we've got a question about how much, if any, of ASX 200 companies have a junk credit rating. I actually don't know that. It's probably something I should have figured out and can figure out, but I will. I will certainly. I'll certainly see if I can get that. So Standard & Poor's put out a report that was looking at global debt and the impact of that specifically mention that S&P stat, which I pulled out. Okay, so Lisa's saying the level of global government debt is so high. How does it impact our overall economy? Does it have a bearing on recessionary trends? Yeah, I mean, I think it does. So obviously, the biggest impact sort of short term is any of the floating rate debt. So remember, you go out there, it's what a lot of people are experiencing with their mortgages right now, okay? So all of a sudden you are paying more for the same house, right? You've already borrowed the money and all of a sudden it just costs you more to live there. What does that mean? Well, it means that you have less money to go out and spend. And it's the same thing with companies. It's the same thing with governments. Now, with 35% of the debt floating rate, that's where we've seen that initial issue. So obviously they're spending more servicing the same debt. They're not getting any additional benefit from debt, which you hope you would get, that you go out there and borrow money and do something with it. That's beneficial. The problem, of course, is that this will continue to get worse as fixed rate debt expires. And of course, as fixed rate debt expires, you've got a couple choices. You can go out and issue more debt at a higher interest rate. So then once again, you are paying more for that. You could issue less debt to replace it. So this will continue to trickle through the economy. There's obviously there's a school of thought that says that perhaps inflation will alleviate this. So obviously inflation is beneficial if you have debt, not great if you have money. But yeah, we'll have to see. But it's definitely going to be negative, Lisa. There is really no positive outcome for paying more for debt that you've already issued or debt that you're using to replace that. So good comment from Don. So he says, I believe government spending is causing most inflationary problems. Seeing no change from governments can only get worse. Must solve productivity problem and government's growing only worsens this. Yeah. So really what Don is saying, and this is really where I'm talking about these conflicts between central banks and governments, right? Governments want to spend more money. So they want to create jobs, of course. They want to go out there and spend more money and grow the economy. That is not good for inflation, right? So what is inflation? It is too much money chasing too few goods, right? So that is the problem. And at the very least, what government spending would do is it would mean that central banks need to be more aggressive in how they're dealing with this. And then the other side of things, of course, is around wages. So kind of the same thing. Higher wages obviously are a contributing factor to more inflation, but they're also the response to inflation. So it's really, people and governments doing what is in, at the very least, their short-term best interest, which can have really long-term issues. But it's very hard to stop governments from spending money, and it's very hard to stop individuals from demanding more money when they're faced with inflation. It's sort of a natural thing that everyone does. But yeah, it's a problem. And a lot of this government spending that happened during COVID and is continuing, many people argue that is really inflationary. So we said, agreed, many governments have given up fiscal responsibility and the central bank is the only mechanism. And you're starting to see, obviously, the concern is that when central bank actions have at least short-term negative impacts on people's lives. So, I think the negative impact that we've obviously read so much about in Australia is the negative impact that is having on homeowners. And it's very true that is a big negative impact. So what you start to see is then a lot of problems around central banks remaining independent, and certainly more calls to reform them or switch their leaders and all sorts of different things. So you do sort of worry about that central bank independence. And that's where you can start to see a lot of pressure on central bank officials to stop doing what they're doing. But yeah. All right, so Tom says this was touted as supply chain inflation, rather normal wage price spiral. If inflation steadies, but supply chains are still tight, can it decrease? This means rates need to stay at this level and stop the increase in inflation rather than decreasing it. Okay, so what Tom's referring to is our new favorite word, the word of the year for 2022 at least, which was transitory. So, and some may think that we were all just in denial about what happened, but since the early 80s, and really the battle against inflation there, a little bit later in Australia into the late 80s, inflation was under control. And seemingly, no matter what we did, it stayed really, really low. And, specifically, I think the lesson that a lot of people took is during the GFC, there was this notion that worked very well is that, okay, we need to go out there and flood the economy with money. So we had all these giant decreases in interest rates, and we had all sorts of other things happening, right? This quantitative easing where basically central banks are going in there and buying non-government securities. So sort of starting with mortgage-backed securities in the US and spreading to all sorts of different things. And this worked pretty well, right? We were supposed to be on an economic abyss, and then, very high unemployment, specifically in the US. Australia never fell into recession. And so this playbook kind of worked. So the exact same thing, just to a little bit of a larger degree, played out during COVID. So, right, the big worry was, of course, that the economy shuts down or large parts of it shut down for a while. What are we going to do? All these companies are going to go out of business. All these people are going to lose their jobs. How do we stop that? Well, it was massive, both central bank actions and also government actions. So a lot of government programs. So obviously JobKeeper, JobSeeker in Australia, but then same central bank actions, dramatic drop in interest rates, huge push to go out there and buy other securities, and now starting to buy corporate bonds and things like that. And I think the expectation was that once again, there wouldn't be any inflation. Now, there's kind of two ways at looking at this. So Tom's saying supply chain inflation. So basically, we had a lot of disruption to global trade. And that certainly was very true. But I think one school of thought is that we missed a lot of other things that had structurally changed with the economy over this time. And a couple of those things, and a couple of the things were helped on by COVID. But really what the economy benefited from previously is there was this huge push that took a lot of cost out of things that we produce. So goods and services we produce as a society. So a couple examples of this. Number one, of course, we had originally offshoring of production. So a lot of things that were produced in Australia and the US, Europe, et cetera, moved to China and other locations in Asia. And of course, initially, when labor was very cheap there, that was a huge benefit to us as a society. It wasn't a benefit if you lost your job because it moved to a factory in China, but as a society, goods and services stayed low. So what did that mean? We could have interest rates that were really low and goods and services still didn't grow that much in price. That was great. It was followed by offshoring. It was followed by some productivity gains as we all moved on to the internet. Trade increased substantially, obviously, through all these different things. And we didn't have a lot of increases in labor price. So we didn't have great increases in wages for a long period of time. Now, there's a lot of theories about why that happened. Obviously, I think the threat of offshoring and outsourcing was one of them. Labor unions became less influential. So, of course, without collective bargaining, that certainly kept wages down. So we had all these things happening really around globalization at the end of the day. And they've started to go backwards. And there's certainly a lot of indications in global trade, all sorts of different things showing that they're going backwards. And really, if we look at what's happened during the same period, COVID happened, a lot of companies and a lot of countries started thinking, wow, we need to worry about where our supply chains are. It's not good enough to just say something's China, it'll show up exactly when we want it to. They started seeing these disruptions and started thinking about the safety of their supply chain, and started moving stuff back onshore. We had the same thing happen with governments, right? So a lot of governments sat there and said, well, this is a problem. We've got a pandemic and every mask is made overseas. This isn't a great spot to be in as a country. So a lot of countries started looking more at self-sufficiency. And all of this, of course, is the exact opposite of globalization. And all of this, of course, is going to make it more costly. Maybe the benefits are worth it, but more costly to produce goods and services. Same time, if you haven't noticed, we've been having some geopolitical tensions. So obviously the war in the Ukraine, I think kind of increased distance between the West and China has not helped. So we've got all these geopolitical issues that are also playing out and is really bringing us back from all the globalization we saw. So I guess the question, and this was a very long way of answering this, is, are we in a situation now where this era of ultra low interest rates not causing inflation is completely over? And, we're still having supply chain issues like Tom pointed out. But yeah, kind of the question is, where do we meet that new equilibrium? Number one, how do we get inflation under control? But where is that equilibrium? My personal opinion, I would kind of say that those rates that we had during COVID will not happen again, and that we are going to settle into an equilibrium that is higher than what a lot of people have expected, and maybe higher than what that some companies certainly, and maybe some individuals, and maybe some governments, higher than what they can actually continue to carry these debt loads on. So yeah, it'll be interesting to see what happens with that. So the anonymous attendee says, will the 36% of junk-rated companies all go bankrupt? They will not all go bankrupt, but let's talk really about what junk status is. So basically, there are credit rating agencies out there like S&P, like Moody's, that go out there and rate companies, and they're going in there and seeing, do they think this company, or what is the ability of that company to pay back their debt? So the problem with being a junk rated company is that if you are someone who has fallen into junk status, then of course it becomes a lot more costly for you to borrow. Because obviously the bigger the chance that a company will default, the higher the interest rate they will have to pay. So it doesn't mean that they're going to go bankrupt. It does mean that potentially they're going to have issues accessing capital in the future. And so they're either the same thing. They're either going to pay more for that debt if they can issue it. And then the problem is, of course, if we are investors in those companies, that does not do good things for us. We don't want companies to pay debt. We want companies to have money to give us dividends and to invest in the growth of the business. So that's all taking away from that. So yeah, that is a problem. The other problem you can run into is potentially it's not just paying more interest on bonds, it's the fact that you can't even issue bonds. So depending upon the company, there could be people that are just not willing to lend them money. Maybe nobody's willing to lend them money. So I think that's really the concern. I would say that I think some of them will go bankrupt. I think sort of the impact of all of this debt and the impact of higher interest rates is certainly going to impact some companies and have them go bankrupt. But no, not all of them will go bankrupt. Okay, so good question. Are there good reasons for investing in a company that is junk credit rating? Yeah, I mean, there certainly could be. So we have to remember as investors, well, two different things. So why would I, if you're talking about investing, why would I do that from a debt perspective? Why would I buy junk bonds? And the easy answer is you get higher interest rates. Now, you have to be very cognizant of if they're going to pay you back or not. But that's why people invest in junk bonds, because they get higher interest rates. And really what you're looking for then is somebody that can go in there, and what we would need, of course, is a manager to do this, somebody that can go in there and and really analyze whether or not that company is able to pay off their debt, and then also hope that potentially that company, remember these credit ratings are not fixed, they can change over time, potentially a company that gets in better shape, and you'll see those bond prices actually go up if they start receiving higher ratings. And many of the funds and ETFs and everything else that invest in this, they don't call it junk. That's just me saying that, although it is a term that's used. They call it high yield, because that sounds a lot better than junk. So these are called high yield bonds. But then on the other side, if you are an equity investor going in there, I think, once again, this makes a company, we talked about business risk earlier, this makes a company riskier. So the fact that a company is heavily in debt, the fact that there's a lot of people out there doubting whether they can repay it, just is really business risk. So why would we invest in that as an equity investor? Why would we buy shares in that company? Well, once again, at a certain point, maybe that risk and reward trade-off is in our favor as investors, right? But we do have to be cognizant that there is more risk involved in these companies. So that's why somebody would go out and invest in that from an equity perspective, because they think the price is right. So just remember that every company does not have the same level of risk. Some companies are a lot safer. You're going to see less volatility in those companies. Some companies have more just general business risk associated with them. So hopefully that answered your question. All right. So let's look at interest rate expectations in Australia. So I said that there is this view that we will start seeing rate cuts sometime this year. So I got this out of the AFR yesterday, maybe the day before. But what this simply shows is where the expectations are for interest rates. And so what you can see here is there still is this expectation, and this did change rather significantly last week. So this is after the change. It did change rather significantly when the minimum wage was raised to such an extent. I think it was 5.75%, if I remember correctly. So yeah, once it was raised to such an extent, I think there were pretty significant changes in interest rate expectations based off of that. And, the thinking basically is, as Tom pointed out earlier, the idea of this sort of wage price spiral, right? So what happens there? Well, prices are up, so we raise wages. That makes prices go up because, of course, labor is such an important part of producing everything. And we keep going in this circle. It's not a circle. We go in a spiral as it keeps going up and building on each other. So yeah, the market changed pretty dramatically, certainly around the expectations for today's announcement, but going forward as well. But you can still see there are expectations that as we get right in the tail part of the year, certainly into the first part of next calendar year, we see that there are expectations that that interest rates will continue to be cut. So you can see it on this line right here. Anyway, so that's what I want to show. All right, so what should we do about this? And then it looks like there's a couple more questions I can get into, but ask anything else. Well, a couple things. Obviously, I don't think anything I said was very positive today, but we do need to realize that at any point in time, there's a lot of uncertainty in the market. And we don't remember this, of course, because there's always this uncertainty that really, really bad things are going to happen. And sometimes they do, but most of the time they don't. It's very hard for us to remember the type of environment we were in 2, 3, 4, 5 years ago, and some of the things that you read in the newspaper every day around what was happening in the market. So just remember, there's always going to be uncertainty. And I hear a lot from investors that they want to wait until it's safe, quote unquote safe, to invest. Well, it's never going to feel safe. So just as a society, and if it ever does feel really safe, that's probably a good time not to invest. But it's never going to feel safe. As a society, we are always catastrophizing about what's going to happen. And there's always these different scenarios where really, really bad things happen. So just remember, things are never going to feel safe. There's always uncertainty in the market. There are also always conflicting views on what will happen. So there are a lot of people out there that are certainly paid to come up with different views and be controversial about what will happen. So you're always going to hear all these conflicting voices, and that increases the level of uncertainty. And then there will always be a lot of advice about what investors should do. Now, remember, everyone giving you this advice, whether they're well-meaning or not, knows nothing about you. They don't know what your goals are. They don't know how much money you have. They don't know what you're invested in. They don't know anything about you. So while we can hear from people in the industry that are investing a lot of money, they're doing what's right for them and the mandate that they're actually following. So we had a conference for our advisors a couple of weeks ago, and some interesting viewpoints we had Chief Investment Officer Vossi Super there. And he got up there and talked about his views, and they were not great. Certainly lower returns. He said definite recession in the U.S. Australia is still out there, and thought that the market was going to take another big leg down. And that was his view. And he runs one of the biggest portfolios in Australia. But just remember, he's dealing with money in the aggregate. You're trying to figure out your retirement. You're trying to figure out your short-term goals, your longer-term goals, dealing with all sorts of different things. So just remember that none of these voices are speaking to you. You need to figure out what you need to do on your own, and that's based on your personal circumstances. One thing that happens to us a lot as investors and as people, so when we're hearing about all this uncertainty and risk, when we're hearing about all these conflicting views and nobody seems to agree on what to do, which they will never agree on what to do, a lot of people just don't do anything. So it leads to a lot of paralysis. So just remember that not investing, and I think I'm probably speaking to a crew of people on here today that do invest. But remember, if we do not have money in the market, what are we giving up? We're giving up time. And it can seem very obvious, and I think we had something in the chat which I can use to kind of address this. Is now a good time to sell stocks and hold cash? That always, with lots of uncertainty, that always feels like the right thing to do. So just remember that when we have lots of uncertainty and we are worrying about things, when the market is fallen, which certainly hasn't this year, but when the market's falling, when there's all this uncertainty, the easiest thing to do if you're really worried about that, to stop the worry, is to sell everything you own and go to cash, right? So any anxiety you may feel just goes away. And it's very easy to justify because you can sit there and say, of course, the market's going to go down. After all these people are shorting the market. Very narrow rally, lots of the things I talked about. It's very easy for you in the head to say, of course, it's going to go down. Going to cash is the smartest thing because I'll just buy back later at cheaper prices. And that sounds very logical, but that's also a very, very difficult thing to do. The first reason why that's difficult is because we don't know what's going to happen in the future. The future is unknowable. Second reason why that's really hard to do is when are you going to get back in? So the problem, of course, is that if we sit there and say, when do things feel safe? Well, they feel safe for us as investors after the market has gone up like 8 years in a row in double digits. Then things feel very safe, of course. But when you should buy, you would have bought in the depths of the GFC, when unemployment was still extremely high, when there's still a lot of people out there saying the global financial system was going to collapse. That's hard to do. So don't think you'll be able to get back in at the right time. So I would certainly say, and the last thing, of course, is remember going to cash, depending upon when you bought your shares and at what price. It's probably going to cost you some money in taxes, money you'll never get back, right? It's probably going to cost you transaction fees. There's all sorts of stuff you're going to pay for this perceived safety you're going to cash. So I'd be very careful about that. And certainly if you're trying to make that decision, think through, okay, what's that opportunity cost and how do I get back into the market? So something to think about. Understand your plan, the different levers that will influence your outcome. So remember, when we are trying to achieve a goal, we hear about returns all the time, right? And that's the exciting thing to talk about. Talk about returns, but there are other things that, of course, influence how much money you end up with. It's a formula, right? So it's the time value of money formula. We want to figure out how much money we're going to have in the future. A couple of things matter: how much money we have now, the returns we earn, but also the time until this future date takes place. So if we're talking about retirement, delaying retirement, of course, and the savings we put into the market. So especially if we think this is going to be a lower return future for us, at least near future, think about those different levers you can pull. Now, I know it's very easy for me to sit here and say, save more money. It's also really hard when you're spending more money on everything as inflation comes up. But just remember, there are different things that we can do in order to try to increase the chance that we achieve our goals. The other thing, of course, when you're hearing about all these things that you should do, the right investment approach, is realize that a lot of people that are out there that are talking about these investment approaches, remember that there's a lot wrapped up in that. So people going out there and talking about value investing or growth investing or anything else, they are generally value investors or growth investors. So their whole career is tied up on this investment philosophy. So they're going to be pretty big proponents of it. But there are lots of different things you can do to be a successful investor. So just remember, there's no right investment approach, but there's likely a right one for you. And having a philosophy that you use and having a plan is what gets you through situations where we get really nervous about future outcomes, right? So the more belief we have in something, the less likely we're just going to give it up because we read some headlines that make us nervous. So just try to find the right investment approach for you, because over the long term, it's most likely that just sticking with your plan is going to be more beneficial for you than going around and trying to find the little investment fad of the day. And that, of course, means keep the focus on the long term. Okay, so got another couple other questions. So Lisa says, oh, no, sorry, Lisa, you're next. I skipped ahead of you. So Damien says, would I be correct in thinking uncertainty compounds, market uncertainty compounds, stock specific, elders uncertainty about the stock already, and the sector commodity market uncertainty should be added in, meaning a larger margin of safety is needed? Absolutely. Okay, so really good comment. So let me go back, and we're talking a little bit about business risk. So let's spend a minute on this. So if we think about a company, every company is different. That means there are different things that influence every single company. And some companies have a lot of things that influence how that company does. So let's use an example. So if you are a commodity producer, you are by definition a price taker, right? You do not have the ability to set a price. You take whatever the market price is. So now we have to look at all the factors that go into that commodity price, right? So if we're looking at iron ore, it's economic growth in China, supply around the world, all sorts of different things that will influence each one of those commodities. Okay, so those are all risks to a risk to your ability to project what's going to happen to that company, which is really what we're doing when we invest. We're projecting what will happen to a company forward. And we're doing that if we're an analyst and being very deliberate about it, but we're also doing that as an investor, right? Somebody, even if it's a very simplistic story, most people will have a story to tell around the share that they're buying. I'm buying a lithium producer because every car is going to be electric and lithium should be worth $1 billion. Right. So we all have, even if it's a simple narrative, we have a narrative about what's going to happen in the future with the company we buy. So in that case, we've got commodity risk. If that company had a ton of debt, then that is another risk associated with it. So now we have to worry about interest rates. Now we have to worry about the company not going through some sort of short-term downturn where they run out of money and can't pay off their debt and they go bankrupt. So that's something that's going to influence the company. The countries that it operates in, how cyclical is it? Is the economy doing well? Is not doing well? So basically, we've got all these different companies that have all different levels of business risk. So when there's more uncertainty about future outcomes, you should do exactly what Damien said. You should demand a larger margin of safety, a larger gap between what we think something is worth and what we'd actually pay for it. So that's a long way of answering that. But now we can get to Lisa. She says, I guess it's all about assessing your buckets. Are you allocating enough to cash in case of recession? Yeah, I mean, absolutely. So, I think that's where it's looking at, okay, if you have a 30-year timeline and you're never going to touch this money, if you're 30 years old and you're investing in super, then you're probably not making these decisions. If you are in the pension phase and you're withdrawing money from the super, yeah, it's looking at cash levels and how comfortable you are in terms of having super support your short-term life, and you can get more comfortable by holding cash. So you don't have to sell anything if your shares go down. So yeah, it's a good comment. Sergey says, no one knows the bottom of the market. Careful planning and move forward. I agree. If somebody does know when the market bottoms, let me know. Don says, I hold more cash, 20% now. I'm taking some profits out, but will buy back in some of my target entities are well below the market value according to Morningstar and others. Okay, well, I like that. I built up cash in my accounts. I haven't really sold anything, but I've been talking about this for a couple of years, so maybe I'm the wrong person to talk to about this. But yeah, I've certainly built up cash too, in anticipation of other opportunities. But I haven't done that by selling. I've just let dividends build up and then some new contributions. And the one thing I will say is I've been very careful to make sure that I am still on track to achieve my goals, even without the cash. And really, where I got that was just years where we had above average market returns, right? So that basically builds in a little bit of a buffer. So, I'm so comfortable I can achieve the return from the things I have invested to achieve my goals. The cash, not hoping for the market to drop. If the market does drop, I'm hoping I can take advantage of this. And Cliff says it's a good time to buy a boat. I would argue it's always a good time to buy a boat. But yeah, just go on your boat, wait it all out. Okay, HC Lee says, what's your take on loading up on Aussie government paper, so debt, short to medium term, even if inflation in Australia takes a longer time to moderate? Possibly that later on, the yield we get on Australian government debt may be higher than the inflation rate. Okay, so let's talk a little bit about bonds and inflation and interest rates and how you access bonds. So the first thing I would say is, a really interesting article was published by Ashley Owens at First Links that was looking at high inflationary environments and the returns on different asset classes. So basically, Ashley went back and looked at, it was 120 years or so of data, and looked at different asset classes and how they performed in inflationary environments. And the first thing is that most of them perform worse when inflation was high. That's one thing to think about. But there were some that had negative real returns. That's a negative return after inflation. And what I would say is government debt was one of those items. And there are a fair number of asset classes that had negative real returns. So the concern you would have on going out there and buying bonds is that you would have negative real returns. So inflation would be higher than the interest rate. Also, the concern, of course, with buying bonds is that if interest rates keep going up, bond prices go down. That's just the way that they work. Now, if you're going in and you're looking at short to medium term, of course, it would have less of an impact, right? So interest rate rises would have less of an impact. So maybe that's not a problem. I guess my question would be like, what are you trying to what are you trying to accomplish with this? So even if inflation, so you said that inflation takes a long time to moderate, but you're buying short and medium term bonds. So I guess the question would be, what are you trying to do? I just put stuff in term deposits. I mean, if you go out there and look at it, I'm getting a better rate for ING than you're getting from a 10-year bond from the Aussie government. Now, of course, I have rollover risk in these short-term term deposits because I don't know the interest rate, what it's going to be once these things mature, whereas you're locking in a rate for 10 years. But I don't know. I just don't really see the risk and return, especially because the way that most people access bonds in Australia is through funds and ETFs, and that can be problematic. Because remember, you're not buying the bonds, you're buying a portfolio of bonds, and that portfolio will continually turn over, which means that you don't get this sort of magic bullet of a bond where no matter what, I'm getting the bond back at maturity. So just something to think about as well, sort of how you access that. Hybrids. So Neil says, can you discuss hybrids? Prices have come off a little given the US banking failures, but now the yield is around 7% on Aussie banks. I will say about hybrids that there are, it's not my opinion, there are a lot of people that think hybrids are very attractive. One of these people is Graham Hand, who runs First Links. Now, Graham is not retired because he obviously still works for us, but he is, I don't think he's approaching retirement, but he's potentially going to start taking money out of super. He likes hybrids. The advantages of hybrids are a couple of things. Number one, they're mostly floating rate, which is really beneficial. So obviously when interest rates go up, we talked about the impact it had of the debt payer. But if you are a hybrid holder, your interest rate will go up. So people do very much appreciate that. The question is, do you think something will happen to Aussie banks? So kind of two different things have happened. There's been the US banking failures. There's also been the Credit Suisse issue. And basically what Switzerland decided to do is kind of wipe out the hybrid holders, which was a little bit of a strange approach. There was a lot in the press here about it. So yeah, I think it's just 7% is pretty attractive in a floating rate. I guess I would say in any environment, that's pretty attractive in a floating rate. So there are some things to be said about hybrids, obviously based on your own personal circumstances. All right. A couple other questions. Oh, good time to buy about. Yep. If you have a home loan, not you, Mark, I guess you read my article, Tom, then your offset account is actually a pretty good spot to park some cash. Yeah, I would agree with that. We don't have offset accounts in the US. Of course, we also don't have floating rate mortgages generally. But I always thought the offset account was pretty fascinating when I came here. Yeah. Oh, Rodney's just answering questions. So I've said that Rodney should just do these. Why take money out of super when you retire? Best to transfer to pension mode. I assume that's in response to Rodney's question. There are a lot of advantages from pension mode, obviously, because you're not paying capital gains taxes or any other taxes when you withdraw it. So yeah, that's great. All right. I think we've done it. Thank you guys. And thank you for all of the comments and questions. I appreciate that. But anyway, a lot of uncertainty, but we will get through this like everything else. And at the very least, I'll be back next week. All right. Thank you guys.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.